The stock of LEEF Brands was up 30% yesterday because of an agreement with a $500 million company, Glass House brand. The way it usually works for me is that I find an interesting stock, usually small, usually unknown. I tell people about it, they refuse to look at it. I say, seriously, look at it. It is hugely undervalued. They say, I don't care. So I literally have to torture them to look at it. When I first introduced LEEF Brands less than a year ago, the stock was at 5 cents. Now it is at 25 cents or up almost 430%. However, the company is still hugely undervalued, and yesterday's agreement with Glass House Brands, a $500 million company, is a big deal. It puts LEEF Brands on the map. And maybe this will wake some people up. Wow, if a top player industry wants to do business with LEEF Brands, then maybe I should pay attention to. Duh, maybe you should, unless of course you hate money. My name is Mariusz Skonieczny and I've been investing in the stock market full-time for 16 years. I'm also the founder of microcapexplosions.com, which is a private membership website for small and microcap stocks. We find unknown stocks, like LEEF Brands, for example, before they become popular. On May 14, 2025, Glass House Brands and LEEF Brands announced a management services agreement for the LEEF El Paso dispensary and off-take agreement. Let me explain what this means and why it matters if you want to make money buying stocks of one of these two companies. You see, both LEEF Brands and Glass House Brands are cannabis companies from California. California is the toughest cannabis market in the United States. But after intercommerce is allowed, meaning that California companies can sell their products outside of California, these companies will have massive upsides. When it comes to cannabis, the business is divided into two parts: flower and the extracts. The flower is self-explanatory. You smoke it. The extracts are the ingredients to make products like gummies, vape pens, or drinks, which are infused with the extracts. Glass House Brands is the top player on the flower side, and LEEF Brands on the extract side. However, Glass House Brands is a fully integrated cannabis company, meaning that it grows its own flower in 3 cultivation facilities, makes its own branded products in 1 manufacturing facility, and sells its own branded products and other brands through 10 retail locations. What's the point of being vertically integrated? Well, put yourself in Glass House Brands' shoes. You have a cannabis farm and you grow the flower. You can sell this product wholesale, or you can use this product to make your own branded products, right? If you sell wholesale in bulk, you get one price. But if you have your own branded products, like Glass House does, you can sell those products at higher prices. Once you have your own brands, you can sell your branded products through retail dispensaries owned by others, or you can sell your branded products through your own dispensaries. Glass House owns 10 such retail dispensaries. Again, selling to dispensaries owned by others is at one price, and selling them directly to end consumers through your own dispensaries is, of course, at a higher price. This has been Glass House strategy, and the company has done incredibly well. As you can see, Glass House revenues increased from $63 million in 2021 to more than $200 million in 2024. EBITDA went from negative $12 million to positive $40 million during the same period. Incredible! With its unmatched capacity, Glass House became a low-cost producer of high-quality flower in California. Gross profit margins improved from 25% in 2021 to about 50% in 2023 and 2024. And of course, because of such incredible fundamental performance, investors rewarded Glass House with an increasing stock price. Today, Glass House has a market cap of close to $500 million. While the past performance has been good, public companies have to always grow, and Glass House is no exception. Glass House agreement with LEEF Brands is just one way that Glass House is planning to grow. According to the agreement, Glass House Brands will be taking over operations of the Palm Desert, California dispensary, the LEEF El Paseo, on behalf of LEEF Brands. Glass House will have exclusive rights to manage all dispensary operations, including but not limited to the sale of cannabis products, the purchase of cannabis product inventory, and employee management. In other words, LEEF Brands will pay a Glass House a monthly fee to manage this dispensary. Glass House will be able to put its own branded products into the dispensary. This is beneficial for Glass House because right now this dispensary does not carry any or much of Glass House branded products. In addition to increasing revenues, Glass House is gaining another retail location without having to spend capital to buy the entire dispensary. I personally visited the dispensary and it is beautiful. Now, let's talk about the benefits that this agreement brings to LEEF Brands. Unlike Glass House, LEEF Brands does not plan to be fully integrated. They tried to have retail locations, but decided to stick to their true expertise, which is the extraction business.
But they've also spent, over a decade becoming experts at extraction. We toured the facility, we documented, what we saw there in our reports. And it's not just the fact that they have the fanciest machines, the latest and greatest technology, but it's the people behind it. They have experts in extraction that are the best that I've met in the business.
By letting Glass House manage the daily operations of its only dispensary, LEEF Brands can 100% focus on the extraction business. But this agreement also includes an offtake agreement from Glass House to LEEF, securing a significant portion of the annual raw cannabis material required to power LEEF's extraction lines. This is a big deal, and in order for you to understand why, you need to understand LEEF Brands' extraction business. You see, up to this point, LEEF Brands was mostly ignored by the market because of its one main weakness.
I used to be an analyst, Penny, and I used to cover LEEF Brands, and LEEF's weakness was the gross margin, that historically it's been in the 30s.
The way the extraction works is the following. You take the flower and you run it through extraction lines, such as the ethanol line, solventless line, and hydrocarbon line. Then you get a product that looks like this or like this. LEEF Brands sells this concentrate to some of the top brands in California. These brands use this concentrate to make their finished products such as gummies, vape pens, or cannabis-infused drinks. However, as mentioned before, LEEF Brands had gross profit margins in the 30s. And this was just enough to be EBITDA neutral or slightly below EBITDA neutral. This is because of inconsistent and not their own flower supply. LEEF Brands had to secure the cannabis flower from 300 different farms. This offtake agreement with Glass House is securing a significant portion of the annual raw cannabis material required to power LEEF extraction lines. This material from Glass House will give LEEF Brands a lot of high and consistent flower quality for its extraction lines. This will also have a positive impact on the extraction yield. In addition to this agreement, something monumental is taking place. About a month ago, LEEF Brands began planting Salisbury Canyon Ranch, one of the largest cannabis farms in the world. Remember how I told you when Glass House was able to grow revenues and margins, EBITDA exploded from negative 12 million to positive 40 million? Well, this farm is going to do the same thing for LEEF Brands. Of course, the agreement with Glass House will help, but this farm is a complete game changer.
I would call it transformational, and I don't think that's sensationalistic.
I agree with Jesse. It will be a transformational moment for our company.
So really excited. Plants in the ground now. First harvest in June. Go back in July. Second harvest around October. And really in the third quarter, Penny, is when we're going to start mixing that material into our extraction line. And investors should start to see, as third and fourth quarter financials come out, our margins really improve by using that in-house material. That's about half the cost if we were to source it from a third-party farm.
And I know you were sourcing from about 300 different farms. So just from a logistics standpoint, this should absolutely help, but the margins is what I'm excited about. And that's one of the things when I've been looking at Glass House and what they're doing and their margins, I see you moving your operations very much in sync with what they've done, just a little bit behind them.
But we're planting 65 acres this year. It's a 187 acre permit for cannabis. So next year we hope to scale into more, and then the following year, within 2 or 3 years, be using that full 187 acres. But when you think about going out into 26 and 27, there's an opportunity for us to continue to use more of our material at that lower cost. So I think this year is exciting, and I'm really excited to see the results show up in the third and fourth quarter, because that'll give investors an idea of how we can boost these margins. But then you can start to think about what that will look like if we were to double the acreage, and then if we got up to the full 187 acres. And this is the opportunity to take all the strengths and great qualities of that business, but change that margin profile and first get us up into the 40s, and then looking out to 26 and 27, there's an opportunity to get to over 50% gross margins there. So we'll be growing at $6 to $12 versus, kind of broadly speaking, currently paying 20 to 40-ish depending on the extraction line.
Yep. Yeah.
Not only will the farm and the offtake agreement improve the supply chain and margins, but the company will finally be able to grow revenues.
We're roughly a $30 million company today. With the farm coming online, I think that we have a double in front of us. I think that we can go from 30 million to a $60 million company, a revenue rate without any sort of M&A. That's just organic growth.
Both LEEF Brands and Glass House Brands have a lot of synergies. I'm glad that they are working together. I would not be surprised if there is more that comes out of this relationship in the future. I believe that both companies have huge upsides. Because Glass House already demonstrated fundamental success, the company is priced at about 2 times 2024 revenues and about 10 times 2024 EBITDA. I think that this is way too cheap. LEEF Brands is trading for less than 1 times revenues, and the farm alone is worth more than the market cap.
We're trading at roughly 20 to 22 odd million dollars at any given time these days. And we recently did get a professional valuation done, and it came in at roughly $40 million. Trade at 20 million, we have a $40 million piece of real estate. So investors are coming in at a severe discount to that today.